To significantly beat the stock market's average annual long-term return of circa 10 to 12%, our trading strategy has to have an edge. Because no matter how knowledgeable or smart we may be, no one is able to consistently predict price action. If we could accurately predict what the market was going to do, we'd be rich in no time, but because we can't know the timing of adverse moves, many option strategies are vulnerable to large losses that can wipe out accumulated profit, or even a trading portfolio itself. The story of options trading using most continuously traded strategies is most often a case of more trades win than lose, but the losses are much bigger in size than the wins, resulting in those strategies ending up not so profitable over the long term due to the aforementioned constantly changing nature of the market and price trend. Trading with an edge, as laid out here, is to be able to profit in up markets, flat markets, or moderately down markets, but most importantly be safe from ruin in a highly unfavorable market. To beat the casino of unknowable timing of macroeconomic trend changes and inherent stock market and stock price unpredictability, we need a trade type that has both an edge in itself and also in the setup and structure of how it's traded. That tilts the odds in our favor over the long term. A trade that sells option time decay, theta in options jargon, is the only certainty in options trading. A trade that has a very high win rate, high positive expectancy, one that can tolerate a wide range of market conditions, where maximum trading capital can be in the market for the maximum amount of time, where the maximum risk at trade inception is not to be risking up to 100% of capital utilized in the trade, where the worst possible outcome for our trading portfolio, in the worst possible market scenario, won't ruin us. And that trade is the wheel. Why the wheel trade has a consistent edge that other trades don't have. Only selling time. An option is a decaying asset. It has a fixed lifespan. Its expiration date is set and certain. We're selling out of the money. OTM cash secured puts, CSP, or when assigned stock, OTM covered calls, CC. An option sold OTM has no other intrinsic value. Its selling price is all and only time value. The sold option will have zero time value when time is up at expiration day. Time decay is certain. As the seller, our income from selling time is guaranteed, and regardless of the eventual trade outcome, we get paid our premium up front at trade inception, thus reducing our capital requirement for the CSP trade. Positive expectancy. A very high percentage, theoretically 70% of CSP wheel trades win. That is, premium profit banked, with no assignment. Put another way, statistically, theoretically 30% or 3 out of every 10 trades on average might theoretically get assigned. In practice, according to CBOE, only around 10% of options trades get exercised and assigned. Market tendency favors it. The predominating overall trend of markets to rise over time favors a bullish-oriented trade like the wheel. Market corrections and crashes tend to be much shorter in duration than market rises, which can remain overbought and overvalued for long periods because investors have a predominant tendency towards optimistic greediness and company management, a self-interested motivation to grow revenue and profit. We can trade through all market conditions. We want to be in the market pretty much all the time because as an income-generating options trader, it's an opportunity cost not to be, since we can't predict when it would have turned out better to be or not be in the market. We need a trade we can live with if the underlying stock price goes either way. The wheel doesn't necessarily require stock price to behave in any particular way to be successful. It's primarily a bullish trade that can also tolerate bearish conditions. Our opinion doesn't have to be right. It's ideal to only sell cash secured puts and never get assigned the stock, so we're continuously scalping theta time decay. Therefore, a flat, rising, or even a less than 20% to 10% downward stock price move is okay for our trade setup. However, we can be wrong and get assigned, but we'll then have the opportunity to sell covered calls until the stock gets called away. It's not a complex trade. Most option traders don't have the level of understanding, expertise, or statistical mind type that can get a handle on all the working parts of a complex trading strategy. While some especially skilled traders can successfully structure complex option trades that make money, it's never without risk, their positions needing close management and adjusting. It's very hard for complexity to beat price unpredictability because continual adjusting to price moves or delta balancing a trading portfolio, for instance. Costs profit. Regardless of skill and knowledge level, the trader is not an edge. Trade type itself and its setup must have an edge over an unpredictable market, consistently and over the long term. The wheel makes consistent, very good returns through a wide range of market conditions when compared to any other option strategy. It's low management. This is largely a set and forget strategy. GTC closing orders can be placed at trade inception, so profits are automatically taken at a chosen closing price. Positions should be monitored daily to check how they're doing, but this is typically a minutes-long process. Many other option strategies are inconsistent. Most option strategies depend on the broader market or market price for the chosen stock to move one way directionally, or to move not too much at all. There's not a lot of range in price movement that the trade can handle, where price needs to go a particular way for trade success. Outcomes can be patchy and tend towards win some, lose some, depending on how market price cooperates for the trade's duration and for ongoing repeat trades of the same trade type. Many positive expectancy option trading strategies that risk 100% of capital in trade as the maximum loss at inception. See average returns on winning trades much lower than 100%. A single bad trade can wipe out gains from many prior wins, adversely affecting returns. Our OTM wheel setup allows for a wider price range of the underlying stock, without needing to try and guess direction and then sweating on a trade's position. It's flexible. We chose a stock we liked, as did many others at the time, whose strategy was to buy the stock, their supply and demand setting its fair market price. We wrote a CSP at 10 to 20% OTM, if put. We'd own stock we like, well below the cost basis of those who also liked the company and paid more for the stock at that time. Selling OTM puts that end up being put as stock at a lower cost basis is safer than buying stock. It's a common buying strategy for many of the great names in stock investing, such as Buffett. Whilst owning the stock, we may be able to write covered calls. An option seller has more strategic options available than a buy and hold stockholder. The few versus the many. Position size. The most efficient use of money is to be able to trade using close to all available trading capital, close to all the time. When trading a wheel strategy, where the maximum risk is to become a stockholder, wheel trades can be made with large position sizes, utilizing all available portfolio capital, whilst trading perhaps as few as 3 positions. Most other option trading strategies, where major or total loss of the trade's capital is the maximum risk, require trading many small position sizes. 3 to 5% maximum position size is often referenced. Most stocks gain with the tide of a rising market, but the reverse applies in a falling market. That is, most stocks in open bullish option trades will lose in a falling market. Keeping position size small doesn't avoid losses or make for higher long-term returns. It just avoids portfolio damaging large losses from one or more bad trades, due to a potential 100% loss of trade capital as maximum trade risk at inception. Often a number of different trade types will be used concurrently, where in any given market condition, some trades will win and some lose. This entails more time, more trading activity, more difficulty keeping track of numerous positions and strategies, much higher trading costs, whilst frequently not utilizing all available portfolio capital. The requirement to trade small means trading against many different stocks that will require a lot more due diligence to find and get to know well. Perhaps a large watch list or the use of a stock scanner. It's better to know a handful of stocks we like and know very well, through more thorough due diligence, than pick and choose amongst the many by scanner or limited due diligence that doesn't unearth the full story of the why of current underlying stock valuation or the company's prospects. It's safer using margin with a wheel. Using margin borrowing to increase returns is a much safer play with a wheel strategy, where stock ownership is the trade's downside. Margin borrowing against directional long or short option trade strategies that risk very large or total loss of trade capital on a large move against the trade is much more risky. The perfect storm. It comes down to maximum risk. What's the extent of the worst downside outcome and frequency of occurrence of such an outcome? Options portfolios can spend a lot of time winning but lose most or all of the accumulated winnings. on those occasions when the market becomes unfavorable for the particular strategy employed. If we intend to trade long-term, a perfect storm will hit at some time and our options strategy has to be able to survive it. Trading a wheel strategy with a worst-case scenario of becoming a buy-and-hold stock owner in markets that have always recovered. We aren't knocked out of the investing game in a perfect storm of worst possible trading conditions and outcome. This is the wheel trade's greatest advantage over any other option trading strategy. We add edge in the way we trade it. We're trading against growth stocks with higher IVs, returning higher portfolio profits but at the same risk level as lower IV stocks. Higher returns reduce risk via a greater downside cushion. We garner profits faster due to the advantageous decay profile of OTM options. We trade larger position size on a smaller number of positions, on companies that after due diligence we know, understand, have confidence in and would like to own anyway. We can safely utilize some margin borrowing to enhance returns. Our trading costs are lower and we're able to utilize maximum trading capital in the most efficient way.